we reintroduced really Anthony Davenport, who moderated the first panel. Anthony, you can start to pop on. And so Anthony, I think we all got a sense of kind of what he does and what he's built up at Regal. I think honestly, when I was introduced to Anthony, I was kind of blown away with just, a lot of business managers tend to be under the radar, but Anthony honestly seems like he's built up a hell of a relationship with a lot of them. And so Anthony's going to do more of a deep dive into kind of what he does and how he works with business managers beyond black cards, how to manage and protect credit for entertainers and pro athletes. So I think with that being said, Anthony, I will let you take it away.
Great. And you can see my screen now, right? With the presentation in the background?
Nice screen, looks good.
Awesome. Well, I apologize to any of you that have to see me for the second time today. That's a lot of fatigue of seeing just my face, but thanks for joining again. Always a pleasure to get to see Jay Barr, who was on the previous panel. Seriously, one of the best they've ever made. So as I mentioned in my earlier panel, in case you saw that, I own a business that's a bit funky. We deal primarily in the world of credit. So we build credit for those that don't have a lot. So as that pertains to business management, we help a lot of people that, they have a #1 record, they came out of nowhere, but now they need to go on tour and they have no credit. Or maybe they're waiting tables for a bit, they didn't have a lot of money, their credit took a beating, and now they need it built up because they just got on an HBO show or Netflix or something like that. We also help repair credit. So we remove late payments, collections, all the things that your clientele might get. And the biggest service that we do is we lock down an individual's identity. So if someone has their name, their address, their social, their date of birth, mother's maiden name, whatever, they're not going to be able to do anything that involves a credit check. And that entails like a credit card, auto loan, mortgage, anything like that. We prevent that from happening. And it's very different than something like a LifeLock because they don't prevent the theft and they don't actually help you clean it up. So we do a lot of that. The final thing that we do, which is new within the past year plus, is we remove people's information from the web. There is a ton of information out there that you can legally buy for $15 from someone's cell number, their cell phone carrier, their email address, their social media handles, contact information for their relatives, list of any of their driving violations or traffic violations. It even gets into like the appraised values of their home and the mortgages that they have on it. So we remove that information because that's what stalkers and thieves are really looking at when they want to take advantage of someone. So we have offices in New York and in LA. I am now mostly based in the LA office, and we're expanding to London with a joint venture to offer our services there. So, we primarily work with the business management community. That's roughly 80% of who we work with. So in turn, we end up working with a lot of high profile, high net worth individuals. That's really what we're catered to focus on. One of the real important things about credit and what allowed us to explode so quickly is the fact that everyone has credit. Everyone needs their credit to do something, but no one actually knows what credit is supposed to look like. What does the perfect credit profile look like? How many credit cards are you supposed to have? If you have a collection, what should you do? Those are just the very basic questions that if you don't know how to answer, you can't advise your clients. So my goal today is to give you enough tools that you can educate your clients in a better method than you might be right now. So you can answer those basic questions. It's important to note that the system is very vague and opaque for a reason, because they don't want you to know how to play the game. The banks want to make as much money off of you and your clients as humanly possible. The rich and famous, they borrow larger amounts of money, so it becomes even more important to them. So there are 3 credit bureaus: Equifax, TransUnion, and Experian. Those are the 3 big bad wolves. And they really, you have to think of what they're really designed to do, which is to collect information and sell it. That is their primary focus. Their job is not to make sure that information is accurate. Their job is not to make sure that you're happy with what's being stated on there. They don't care. They just collect data from a whole bunch of sources and then report it. And the paying customer in that situation are lending institutions, primarily banks, others who want to say that, you're, saying how old you are, where you live, when your lease is going to expire, so that then they could send you an offer that says, hi, we know your lease is coming up. How about this new one that you're pre-approved for? So that's what they do. Now, they don't actually make up a score that lenders use. And this is really important to point out. There's another company called FICO. FICO is the organization that looks at the information on these three bureaus, and then they will give you a score based on that information. And what makes up this score, I kid you not, used to be a proprietary and secret formula that wasn't released for 40 years. And then finally someone got a hold of it and they showed it out, and FICO wasn't too happy. So what makes up that score is the following. The largest chunk of it, 35% of it, comes down to your payment history. And that makes sense that the largest thing that makes up your FICO score is your payment history. But what's surprising is that 65%, the bulk of your score, has absolutely nothing to do with whether you're paying your bills on time. And that's often the 65% that you can control. You can't control right now if your clients are not making money because they're not on tour or they're not making a lot of films and TV shows. So that part may just be out the window, but the other 65% you absolutely can focus on. The next part is 30%, which comes down to the balances that you'll have on individual credit cards. And here's where it gets funky, because it's not looking at your overall debt and saying you have 5 credit cards with a total available limit of $200,000. They're looking at each one individually. And so how this can hang you up is, I talked to an individual who is an owner of a professional sports team, one that you all have heard of. And basically his score was too low to qualify for what he called a few measly millions of dollars to borrow for a house. And I looked at it, and it's because he had a gas credit card that had a limit of $500. And this is literally just what he gives to his driver to use to fill gas up in the car he's driven around in. But because the balance was like $480 and the limit is $500, his score was crushed, almost as much as if he had missed a payment on a credit card. And the reason for that is because they're going to look card by card by card. And nowhere in this pie chart is income, assets, fame, whether they root for good teams or bad teams. It really just comes down to per card usage. And another aspect of it is that you could say, hey, my clients pay off their bills every month. Like, you're the ones that probably make the payments. That doesn't actually matter, because they're only going to report the balance to the credit bureaus every 30 to 45 days. So that means that, this guy, he was definitely paying his bills on time. He had someone do that for him. But because of the day that they report the balance, it happened to report on a day when his balance was very high. And as a result, his score is greatly impacted. So you really need to pay attention to that. I'll get into best practices later on about like when your clients are going to make a major purchase. How do you make sure their credit is as sexy as possible? I like to say it's better than saying making it optimal. So the next 15% comes down to the length of payment history. They like to see that you have a long history with your creditors, and think of it just like your friendships, right? So they're looking to see that you not only have just one friend, but you're looking to see if there are a few friends that you know for years and have a good relationship with. That is absolutely key, and that's an overlooked aspect of things, and that's something that hurts a lot of emerging artists, which is one of the reasons that you have to hire me sometimes to build up their credit quickly. The next 10% comes down to a variety of credit. They want to see that you can handle a multitude of different varieties of credit. So not just credit cards, not just mortgages, not just auto loans or student loans, installment loans. They'd like to see ideally all of those different types of things. And that can really help when you're looking to get something like a mortgage, because they're going to say, hey, you're adding this to the mix. How are you handling the other types of debt that you have? The final 10% is what causes people to lose sleep at night, which is inquiries, new debt that you're obtaining. So that is really something you shouldn't lose sleep over. Everyone's deathly afraid of having their credit pulled, but they really shouldn't be, because a single inquiry is not generally going to impact you. In fact, a single inquiry typically impacts someone by 0 to 2 points. That's nothing. So don't be afraid to have your client's credit pulled. And there's actually a few exceptions to that rule too, because again, the credit bureaus make money only when people buy credit reports. So they don't want to make it so that no one's ever requesting their credit. So if you're applying for a mortgage, an auto loan, a student loan, or a rental property, they will lump inquiries from all those institutions for a period of 45 days. And they'll just say, all right, you applied for a mortgage with 10 different banks. They will count that as one single inquiry. And that one single inquiry will typically impact your client by 0 points. So don't lose sleep over that. Don't let your clients lose sleep over that. It's important to note that they can't apply for a mortgage and then a rental property and then a student loan and a car, because those are each different buckets. So if they did that, it would be 4 inquiries. Now, once FICO, takes a look at each credit bureau, they're going to issue a score that you can consider your modern day report card. And that ranges from 300 on the absolute low end. Nobody has a 300 FICO score. I don't care how bad they are, how few bills they've ever paid. Nobody has a 300 FICO score. On the opposite end is an 850. Nobody has an 850 FICO score. Anyone who had even close to that, like their credit score is etched in a tablet, it's carried down a mountain, it's praised by all. Like nobody has that. And I know what you're saying. Well, I pulled up this report and it said I have like an 860 or an 849. I have really, really, really bad news for you. Those are probably not FICO scores. The credit bureaus themselves sell their own scores. And if you read the fine print on them, they always say they're not FICO scores. Sometimes you'll get provided a score from, your credit card or something like that. Those are completely bogus and made up. Sometimes they'll say they're FICO scores, but they're not based upon the same reports that lending institutions get. Which leads me to my next point. Where can you get the same credit report that all lending institutions use? Virtually every single one in America. There's only one place you can get it, and I'm going to tell it to you. www.itdoesn'tfriggin'exist.com. And again, back to the earlier part, I mentioned that this whole credit system is a game. They don't want you to know the rules. So most banks are prohibited from actually giving you a copy of the report that they see. They want you to have to get something bogus, like directly from the credit bureaus, which isn't going to match up. The biggest difference between those reports is that the ones from lending institutions look at a 7-year history. The ones you can get look at a 2-year history. Also, they're not really super valid with the information. So if you were to say you had a client that wants to get their credit repaired and you send me their American Express Credit Secure report, if you send me their report from Equifax, my team is forbidden from looking at that and then using it to make any sort of educated guess as to what your client should do. So Another answer is, where can you get these reports? I'll tell you a secret. I let everyone in business management request one from us. We have a process to get the same ones the banks use. And for any of the partners that we work with, we pull them, we send an analysis written by a certified FICO professional, AKA credit nerd, and it will tell you exactly where your client stands and then where, what ways that can be implemented to improve upon that. So at any rate, now what's considered good has shifted over time. So I used to be a mortgage banker. I'm atoning for my sins now by helping people instead of, giving them mortgages and things like that. But when I was a mortgage banker, if you had above a 620, they consider that A paper, and you could literally, you could get whatever the rate was. Like, there was no differentiating between, a 620 and an 800. They would just say, you get the rate. But now, since the last recession, that has shifted to a 740. 740 is now the new A plus. And it's also important to note that because there's 3 different bureaus, that means you have 3 different scores. So just like you can see, I highlighted a few of these here. Let's say that one bureau has your client at a 640, one has them at a 700, another has them at a 740. Which one do lending institutions primarily use to make a decision? They take the middle. So it would be a 700 in this one. Have I seen scores vary by that much? Absolutely. We see them all the time. So it's important to get a real copy of the credit report and then know how to read it so that you can figure out the middle score and say, that's where they're going to put you. And a 700 is going to be good enough in some cases to get like a jumbo mortgage, which is, depending on which county you live in. Your clients are all getting jumbo mortgages. And nowadays they've increased the minimums for that because of the current crisis. So you really want to have a 740 or higher. That's what it's going to take to get an optimal mortgage, an optimal rate on your credit cards, so on and so forth. Now, there's a lot of myths about what is the real ideal credit profile. And it took me years of working in this industry to kind of boil it down to something simple. But some of the myths are that paying off your debts monthly will not necessarily benefit you. I mentioned that already, that they're only going to look at every 30 to 45 days of what your balance is on a card. It's also rare for too many inquiries to hurt your score. So don't get worried about that. Don't let your clients get worried about that. Another assumption is that people believe that because they have a lot of money in the bank and that they pay their bills on time, that their credit's good. And that is not entirely true, because they may not have the ideal profile. The amount of income, assets, fame doesn't matter whatsoever. People say, well, my client is such and such, they're a superstar. Doesn't the bank care about that? No, they really don't. Another thing is that when someone's going through divorce, or they've gone through a divorce, and there's a divorce decree that states that, I'm responsible for this debt, you're responsible for that debt, the lenders don't care. They said, hey, we lent this to you, and we didn't say, well, if things don't work out, that's okay. They just said, no, you both are responsible for it. So a divorce decree does not absolve you of any responsibility. And another thing is, some people say, well, I co-signed for my friend. A lot of your clients, when they start making it, they're going to want to co-sign for cars or credit cards or whatever. And they say, but I only co-signed for it. Co-sign means I am responsible for this payment just as much as the other person. And there's no ifs, ands, or buts about that. So one way that you can maintain the ideal credit profile is to maintain anywhere from like 3 to 5 is an okay number. If you can have a couple more than that, that's great. But you want to have that many trade lines. And trade lines are anything that's going to report to the credit bureaus, like a credit card, a mortgage, auto loan, etc. You also want to have a variety of those different types of accounts. So as I mentioned, have multiple different types of accounts open. One thing that, I do personally, because I use a credit card on an everyday basis, but I have others that literally just stay in a drawer, and I use them like to pay my Netflix bill, and then they zero out at the end of the month. Another one pays the Wall Street Journal subscription. I subscribe to the London Times now because, it's important to know what's going on there. all those are going to different credit cards and they automatically zero out. And that keeps my credit very strong. It keeps my utilization low. And that's a very good tip to use to keep your credit score constantly high. And there's actually an exception to this too. So American Express has charge cards. Not all of their cards are charge cards, but the ones that are, they will allow you to put any amount of dollar on that card within limit, and it never negatively impacts your FICO score. So my go-to everyday credit card is an Amex for that very reason, because the balance will never negatively impact me. Where on my other credit cards, it does impact you. And you ideally want to keep your balances below 10% of the limit. That's something really key to do. But if you have an Amex, it's really easy because it never negatively impacts your score. Now, collection accounts are something that are a specialty for us to clean up. And the reason for that is because they just happen for a myriad of many ridiculous reasons. One of the biggest reasons that it comes up is because our medical system is just a complete and utter disaster. So I'll give you my own story. There was a time when I was commuting from Brooklyn and Manhattan via bike 4 times a week. And I was trying to win the war on being chubby. I've since stopped trying to fight that war and just accepted that it is what it is. But at any rate, back then I was riding over Manhattan Bridge and my bike hit something. I went flying over the handlebars. I broke my arm. I sprained both of my wrists. And what I was really worried about more than my pride was the fact that I knew I'm going to go to a hospital and literally everyone that you touch is a different bill to your insurance company. So I get checked in. That's a bill to my insurance company. Next person kind of wipes me down, gives me a couple bandages. That's another bill to my insurance company. Then they were like, oh, well, you need an x-ray. There's an x-ray technician. That's a third bill. There's someone that actually told me the results and said my arm is broken. That's another bill. I get a sling. I get Advil. I mean, every one of those things is a different provider, some in network, some out of network. It's not like I'm bothering to, ask them, hey, do you take this insurance, as they're showing up to like wipe me down. So at any rate, the end result of it is I knew I had to keep an eye on my credit because collection agencies, that's what they do. They collect money. Hospitals, ERs, doctors, that's not what they do. So they will literally send a bill to the insurance company. If the insurance company feels like paying it, they will pay it, but they don't like to pay bills in full. So any balance stuck in the middle is how a collection account happens. They're not going to write to you. They're not going to call you. They're just going to sell the debt to a collection agency. And for those of you that deal with athletes, we found that 70% of athletes, pro athletes, have medical collections when we pull the reports. And it's because they see doctors more than anyone else. Even though the leagues generally pay for their insurance, it's still the same thing. So one key thing when dealing with a collection, and I can't tell you how many companies I've told this to when it's too late. If you simply pay the collection, it's like admitting guilt and it crushes your client scores. A single collection on average will impact someone's FICO score by 70 to 100 points. So you really have to know what to do when you're dealing with a collection account, or just don't deal with it at all. So I mentioned in here some of the things to look for when you're looking at a collection, but it's things like if the incorrect amount is billed, if they've added interest, if they're reporting it twice on your credit report. Those are things that make it extremely easy to get them removed. That's the kind of nerdy stuff that our team really digs into, reading the laws that are available. If it's a medical collection, there's a whole other separate area of laws like HIPAA, where they're not supposed to share information about you, but they violate that stuff left and right. So the key is, if you don't know what you're doing in the collection, you're not really going to learn about how to deal with it. Just leave it to the professionals, because you could do more damage than good. So now the next part is when your clients are going to buy a home, you really want, or any sort of large purchase, you want to have their credit in as good a position as possible. And if you don't have that, this could cost them hundreds of thousands of dollars over the lifetime of a mortgage. And it's really key to note that a mortgage is usually the biggest thing that they're going to acquire. And most people don't really pay attention to their credit until they apply for the loan and then say, am I going to get the best rate or not? So you really should know what to do in advance. And the best thing that you could possibly do is 60 days before you apply for the loan, you want to pay off every credit card balance that you have. So you want to pay down all the credit cards as low as possible. Try to refrain from using them unless it's an Amex charge card. Then charge away. It won't ever have an impact. But that can improve your score by as much as 30%. And the difference is massive. When I showed you that chart earlier, for example, historically, a 700 score is what you need to have in order to qualify for a jumbo loan. And you get the very best rates above like a 740, 760. There's about 5 different buckets of prices that you can get for rates between 700 and we'll call it an 800 score. Now, this is all a money-making scam because they show that someone who has a 700 score is just as likely to default on a loan as someone with an 800 score. But now they've got a reason, a numerical reason that they could say, well, you're a higher risk. You're really not, but they will give you the loan, but they're going to charge you more for it. And when you're having your clients apply for a loan, you're generally asking, what's the rate? You're not asking, what's the rate and what's the rate if my score is better, or how much of a premium are you charging because my client has a 717 score. So those are really key things to pay attention to. And right now, in the current lending environment, the lenders are really stiff. They're not bending. They've increased their minimum scores by a lot is what we're finding. So that's put a lot of pressure on our credit repair service, because now people that could have breezed through are saying we can't get this at all until it gets done. So now another aspect of what's going on, speaking of COVID, is identity theft. We're going to get into like all the different ways that your client's information is out there. But for starters, identity theft is up 300% since COVID began. That's what some of the articles are putting out there. But I got to tell you now, it's so much higher than that. Our business is exploding right now because of the amount of identity theft that we get called about, where people are getting a hold of their clients' information. They're filing things like unemployment insurance. They're applying for the SBA loans. They're applying for Social Security early. So you really have to be cognizant that this is a huge issue, and there are some things that your clients can do. Out of all these stats, what I really want to point out are 2 of them. One is that nearly half of all identity theft that's reported occurs among the 1%, because that's where the money is. And the thieves know that. They're going to go after people that have large sums of money versus someone who may not. And the other part is 66% of the theft isn't someone getting a hold of your credit card and charging it up. Usually what they're doing is they're opening up a new line of credit in your name. And one of the big reasons for that is that your credit card companies keep an algorithm on you. They know where you spend your money and what you typically are going to spend money on. And if I were to all of a sudden spend $1,000 at Dress Barn, they're going to flag that and say, that's not a typical transaction. And they're really, really good at that. So the thieves know if they open a new account, there's no algorithm. And that's why, protecting your credit and locking it down is going to be the best thing that you can do. So now some of the ways identity theft happens is beyond your credit. It's also medical identity theft. That's when they take your information and they say, okay, you're more prone to needing knee surgery because of your past history. So they'll come up with some bogus claim, the insurance company, to pay off Dr. Dewey, Cheatham, and Howe for fake knee surgery that you never had. And that's why 1/3 of all hacks right now are with medical institutions. There really is no way to prevent that. I don't know one yet, but I'll circle back once I do. But new account fraud is typically the biggest one. Thieves can get a hold of your information in a million different ways. Often we're asked, how did they get a hold of my client's info? And it's like, there could be one of the more than 1,200 institutional breaches that's announced every year. There's more than that, but those are the ones that are announced. Could be, phishing scams, email phishing scams have gotten super, super good. Thieves are hacking into your email because usually email, especially your clients like Gmail and Yahoo accounts, that has such low security. It's a joke. And if your clients don't put two-step verification on their emails where it gets, to their cell phones, that makes them way more prone to having someone take over their emails or just monitor it for months. And that's why you'll get this wire request of, hey, remember I said I was going to China? Well, I'm here and I want to buy, Anthony's Chinese art, and, wire it over right now immediately. Like, they know who your clients are communicating with to make these things happen. This is exactly how. So really encourage them to do two-step verification. Mail theft is another thing that's been happening, where people take mail. And I talked to a business manager that might be on this Zoom, in fact, where Chase sent one of those pre-approved cards in the mail. He didn't get it. The thief got it. And then they activated the card. They charged it up. And Chase doesn't want to pay. They just don't want to pay. So one thing that you can do is opt out of all of those pre-screened offers. And I'm going to give you a real website now. optoutprescreen.com. optoutprescreen.com. It takes 2 seconds to go there. Do it for your clients. We do it as part of our onboarding process for our credit protection service. That will stop junk mail like that from coming. It's all pre-approved offers. If you do it online, it's good for like 2 years. If you print it out and send it in, it's good for 5. Just keep that up to date. It'll cut down on a whole bunch of junk mail. I can't cut down on spam email or spam calls, but I can definitely, help you cut down on spam mail. So that's one key thing to do. Also, if you're concerned, like if you have a client that has a high profile and they like privacy, you should purchase one of these legal background reports, or I can do them as a company every now and then if you have someone that you want to see, just to see what kind of information is out there. But as I mentioned, these background reports are available for $15, some a little less than that. There's some companies that will let you pull in unlimited reports for $30. I don't know why anyone would have a legal need to do that, but at any rate, they do. And it's a scary amount of information on there. And based upon that information, you want to make some steps to improve their security and get that information removed. Now, one of the reasons that the dark web is like so difficult to navigate and also so lucrative for thieves is because they literally list out the information in companies that are designed to look just like Amazon. So they have different categories for different things. They're like, do you want a bank account? Do you want access to one that has $5,000, $10,000, $15,000? Here's the fee that you're going to pay for that. And it's surprisingly cheap. Getting access to your credit card is worth $1 to $2. And City National Bank is proud of the fact that they're one of the premium credit cards. So if you get a hold of a City National Bank one, it might be more like $2, but that's nothing. If you want to get someone's social security number, it's $3 to $5, and that's it. So it's very, very cheap to do this. It's very, very lucrative. And, one of the things we cover is that, thieves have shifted and changed the way that they do things. Back in the day, the gangs would want to deal in drugs, but that's not very lucrative. There's a great book called Freakonomics that gets into like how the average drug dealer on the low end was making like $2.50 an hour, with the hope of getting to be one of the top guys making a lot of money. But it's pretty dangerous. You're standing on a street corner and you're just like very visible for everyone to see. They know that if it's February and it's New York City and you're standing on a corner, you're dealing drugs. So they've now shifted to doing a lot more online theft. And something that you have to worry about in your industry is what are called tax hose. And yes, this is the first CPE you'll ever hear someone talk about hose, but they're called tax hose because these thieves get a hold of all the information to file a tax return fraudulently, but they need more addresses to get these phony refunds sent to. So they get these tax hos that agree to receive the refunds and then give them a portion of it. So gangs have become organized to do more of that type of activity because it's far more lucrative. They're far less likely to get caught. It falls under the guise of white collar crime, actually. So if they are caught, then they're sent to like a white collar prison where they, have basketball tournaments, tennis, yoga. They can learn financial tips from Bernie Madoff's team. I mean, if you were a criminal and you had to realize, there's some risk in there, you would choose this for sure. Now, the last part I want to get into are the various different means of preventing identity theft. Credit monitoring and alerts is like a LifeLock or getting one from Equifax, Experian, etc. The upside to it is it's cheap. You can get it for free in most places. I don't believe in paying for it. The downside is it doesn't let you know about theft until after it's already happened, and then they're not going to help you clean it up, despite what the commercials say. There's also a fraud alert where you can place a fraud alert. The upside to it, you put it on with one bureau, and then it impacts the other the other two, and you can manage it in one place. But the downside is that actually doesn't stop someone from opening an account in your name either. It's just meant to say, hey, if you're reading this, please put a little extra scrutiny to make sure it's me. But almost everything is done through an online automated system now, so you won't see that. Security freezes are the golden standard of preventing theft, but the problem is they're very time consuming and difficult to manage. I know I've met a lot of you that were trying to manage it for your clients, and then you gladly toss them over to our firm to handle because it's a pain, especially when your clients are trying to do it on a Saturday. They forgot, they're at the car dealership, they want to get it right then and there. And they intentionally make it a difficult process because the credit bureaus can't sell your information when it's frozen, and they don't like that. So they make it a pain in the butt. And you can also remove yourself from pre-screened credit offers, as I mentioned. So I also have a book that came out a couple of years ago. It sold 25,000 copies and counting. Oprah magazine included an excerpt of it. So for your client, aren't going to want to pay for like a service like mine, but they want to know how to do the basics, I highly recommend this. If you want to give it to your clients' kids so that they start out in the right setting, I've heard a lot of people do that, and that's really effective. We've been in lots of press and media, and here is our contact information. If you have any questions about our services, please send an email to info@regalcredit.com. If you would like me to do a seminar like this for your firm, I do that all of the time in normal days, but it's obviously not quite a normal day. So this is the way to do it. But Matthew, thanks for letting me drop some knowledge on the credit side.
Thanks, Anthony. I think you have everyone here bookmarking your links. You had me at the first one. I was ready to go, and then I was like, But anyway, yeah, there was some conversation about the other one, the optoutprescreen.com. So anyway, thanks so much. That was a great deep dive. Kind of a super interesting space, right? I again didn't kind of realize all of these details. I'm like ready to sign up myself, so I'll email you after this. Thanks so much. Thanks again for moderating the first panel. I think we'll take just a short couple-minute break here, get the next presentation set up. The next one is going to be super interesting. It is about concierge travel, the rise of concierge travel. And we're going to look at it from both the travel side of things and also insurance. So, all right, thanks again, Anthony. We're going to take the stage down here for a couple minutes, and we'll be right back in about three minutes or so. All right, thanks, guys.